Welcome to the Deep Dive. Today we're plunging into the latest results from UltraTech Cement, Q1 for their fiscal year 2026.
Right.
And this is a huge player we're talking about, the third largest cement producer globally, outside China anyway. Their latest moves, well, they give us some really interesting clues about their strategy and, the wider Indian economy too.
Absolutely. And what's fascinating, I think, is just how much you can actually pull from, a single set of filings in an earnings call. We've got the board meeting notes, the financials, their investor deck, even bits from the Q&A on the call.
Right.
So our job today is really to sift through all that, pull out the key stuff, and help you understand what's really driving UltraTech's performance and, well, what it signals for the market.
Think of it as your shortcut, basically.
Okay.
You're briefing on a company that is literally building the nation. We're going to unpack their pretty impressive financial leaps, get into their growth plans, acquisitions, integration, all that, and then look at some maybe surprising details on how they're running things efficiently and their whole sustainability angle. So let's dive in.
Let's do it.
Okay, kicking off with the big numbers. UltraTech Cement, Q1 FY26. Seriously strong results. Consolidated net sales hit 21,040 crores. That's a 13% jump year over year.
Yeah, up from about 18,600 crores. And it's not just the top line. Their PBIDT, that's profit before interest, depreciation, and tax, reached 4,591 crores. That's a massive 44% increase compared to last year.
4%, wow.
And the profit after tax PT also jumped significantly, 49% up, hitting 2,226 crores. So what this means is their consolidated net profit margin, it went from 8% last year to 11% this quarter.
That's a healthy improvement. It shows they're not just selling more, they're making more on each sale.
Exactly. It signals real strength in the core business.
In that operating EBITDA per metric ton figure that really caught my eye, it rose by 337 per ton year over year, now sitting at 12,248. To me, that screams efficiency gains at the operational level, getting more profit out of every single ton.
Definitely a strong indicator. Now, where it gets really interesting, I think, is their strategy around expansion.
Right. Acquisitions. They're not just growing organically.
Not at all. They're making some big moves. The Kesoram Industries cement business deal, that composite scheme became effective March 1st, 2025.
Okay.
But the key date is April 1st, 2024, the appointed date. So they've actually restated their financials from back then to include Kesoram. Gives us a clearer picture of the combined entity.
Got it. But the really big story, maybe, is the India Cements Limited, ICM.
Could be, yeah. They got an 81.49% controlling stake by late December 2024, so ICM is now a subsidiary.
And the turnaround there seems, well, incredible. India Cements generated 92 crores in EBITDA this quarter, after losing 9 crores last year.
It's remarkable.
How are they doing that so quickly? What's the playbook?
Well, management shared some details. It sounds like a pretty comprehensive effort. Things like debottlenecking assets, particularly up in the north where the market's lucrative. That alone freed up about 0.3 million tons per year of capacity.
Just from tweaking existing assets.
Exactly. And they're planning a big CapEx program, too, focused on efficiency, productivity, waste heat recovery systems, WHRS, preheater mods, cooler upgrades, using more alternate fuels. It's about optimizing what they bought.
And they've put a timeline on it.
They have. They expect this CapEx to wrap up by fiscal 28. And the goal is to get India Cement's EBITDA over 1,000 per ton by then.
It's a huge leap from where it was.
It is. And tied into that, they're boosting the green power mix at India Cements massively. From just 3% now to, get this, 86% of their power needs by FY28.
86%. That's a game changer for costs and carbon footprint.
Huge. And another smart move seems to be the branding. They're rapidly rolling out the UltraTech brand across India Cement's operations.
How does that work financially?
UltraTech keeps a small margin, about 10 euros a bag apparently, for marketing costs. But the core benefit of that stronger UltraTech brand recognition, that gets passed straight to India Cement's bottom line. The plan is 100% brand transition by the end of fiscal 27.
Leveraging their own market clout. Makes sense. And there are smaller deals too, right? Wonder Wall Care.
That's right. Wholly owned subsidiary now, May 2025, gets them into wall putty-related products, diversification. And internationally, their Middle East arm, UCMEL, upped its stake in RAKWCT, that's the Ras Al Khaimah White Cement Company, to over 66%.
So expanding product lines and global reach bit by bit too. Okay, so with all this strategic stuff happening, how does it translate to the day-to-day operations, the volumes?
Well, consolidated sales volume hit 36.83 million metric tons. That's up a solid 9.7% year over year. And that includes the impact of the acquisitions.
Right.
And interestingly, it's not just volume, their premium product mix. That jumped 41% year over year.
41%.
Yeah. Premium products now make up nearly 34% of their sales. That usually means better margins. Plus, their retail presence, those UltraTech Building Solutions outlets, UBS, they grew to over 4,800 stores.
Wow.
And those stores account for 21% of their domestic gray cement sales. That's a powerful channel.
Absolutely. What about their own production capacity? You mentioned freeing up some through debottlenecking.
Right. They added another 3.5 million tons per annum capacity in Q1 FY26 overall. Brings their total gray cement capacity to 192.26 million tons per annum now.
And the target.
Ambitious. 212.2 million tons per annum by FY27.
How are they adding capacity so fast? Is it all new plants?
Not necessarily. A lot seems to be, like you said, debottlenecking and efficiency improvements at existing sites. Brownfield expansions, it's often quicker and cheaper than building brand new greenfield plants. It's smart capital use.
Makes sense. And what about ready-mix concrete, RMC? That's
Yeah.
key for cities' infrastructure.
Crucial. And they're expanding there too. RNC plants are up to 397 now. That's 81 more than last year. Volume grew 20%, revenue up 23%.
Big jumps.
Yeah. And they use a lot of their own cement internally for RMC, about 1.1 million tons this quarter. Shows that integration.
And management seems confident about competition in RMC.
Very much so. They basically said they're focused on their own growth path. They see RMC adding to their margins, and they're not really worried about competitors. They're playing their own game.
Right. Okay, let's switch to costs. Always critical in this business. Energy costs overall were down 12% year over year.
That's a big help. And digging into that, fuel costs specifically for gray cement, down 14% year over year, just 1% down from the previous quarter, but still, it's $871 per metric ton now.
And that's even with imported fuel prices being fairly high.
Exactly. A blended imported fuel was costing them $127 a ton.
Yeah.
So how did they manage the drop? A key piece is their clinker conversion factor. It improved. Went from 1.44 last year to 1.49 this quarter.
Kidding.
Meaning they're getting more clinker, the key ingredient, from the same amount of raw material and fuel. Better efficiency in the kiln.
Got it. And power costs.
Also down. 8% lower year over year, 356 per metric ton. And a big driver there is that shift to green power you mentioned. Their green power mix is up to nearly 40% now, from about 28% last year.
Mostly from waste heat recovery.
A lot of it, yeah. Their WHRS capacity is now 363 megawatts. That's substantial.
And logistics, getting the cement out there.
Costs down there too. 4% lower year over year, 2% quarter over quarter. Now all 1,158 per metric ton. They mentioned reducing their primary lead distance, how far they truck it initially, down to 370 kilometers. So optimizing routes.
So, okay, raw material costs ticked up slightly, 2%.
Yeah.
But overall, energy, power, logistics, all down. It paints a picture of a company really, really focused on managing its costs, right?
Exceptionally focused, yes. Through operations, through green energy, it's impressive control for a commodity business.
Okay, what about their financial health overall? The balance sheet.
Looks pretty solid. Consolidated gross debt is around 22,800 crores. Net debt after cash is about 16,340 crores. Gives them a debt-to-equity ratio of just 0.30.
Very manageable.
Very. And their interest service coverage ratio is strong too, 9.15 times. They can easily cover their interest payments.
So financially stable. What about corporate governance moves or other strategic decisions from the board this quarter and extend out?
Yeah, a couple of things. Besides approving the results, they recommended appointing Deloitte Haskins and Sells as one of their joint statutory auditors. That needs shareholder approval, but it's a change in their audit setup.
Interesting. Why now, perhaps?
Could be various reasons. Standard rotation, desire for a fresh perspective. It's a significant governance move anyway.
Okay. Anything else?
They also recommended adopting a new memorandum of association and tweaking their articles of association, basically updating their corporate charter to align better with the current Companies Act.
What kind of changes?
Adding clauses related to things like electricity generation, which fits with their WHRS and green power push. Also, clauses for leveraging e-commerce and tech-enabled distribution.
So that signals they see themselves as more than just a cement maker, moving towards like broader business solutions.
Exactly. It reflects that evolution. And one more thing. A new independent director was approved, Mr. V. Chandrasekaran. Starts in August 2025 for 5 years. Chartered accountant, lots of experience in finance, investment. He's replacing Mr. Sunil Dugal. His term is ending. So, adding more financial expertise to the board as they grow.
Makes sense. Okay, let's talk sustainability. It seems like more than just buzzwords for them. Ranked ninth globally by S&P Dow Jones Sustainability Index.
Yeah, and the highest ranked Indian cement company for the fourth year running, that's significant recognition.
And it shows up in their operations.
It seems to. Their Noakari limestone mine got India's first ever 7-star rating for zero waste mining, and 12 other mines got 5-star ratings for sustainable practices. These aren't just awards, they reflect actual operational changes.
Right, minimizing impact at the source. And I saw something about packaging innovation.
Yes, they won an award, FIPSA 2025, for responsible packaging. They developed cement bags using 50% recycled polypropylene.
50% recycled content in a cement bag. That's quite something.
It is, and the scale is impressive. They said the initiative used 20 million recycled bags, consumed 650 tons of recycled plastic, and cut virgin plastic use for those bags by 43%. That's tangible circular economy stuff.
Definitely. And carbon capture. That's the big frontier for cement.
They're working on it, partnering with IIT Madras and BITS Pilani Goa on a carbon capture utilization CCU pilot project.
A pilot.
Yeah, a 3-year project focused on developing homegrown CCU tech specifically for the cement sector. UltraTech is putting in 25% of the cost and helping set up a 1-ton per day capture prototype at one of their plants.
Investing in future solutions. That's important.
Crucial for the industry's long-term sustainability. And you see these efforts reflected across their ESG scorecard improvements in clinker factor, WFRS mix, renewables, alternative fuels. It's a broad push.
Right. Now, it's not all smooth sailing, is it? There are always challenges, legal issues.
True. Even strong companies face them. They're currently in a legal fight over the revocation of West Bengal incentive schemes.
What happened there?
Well, the state government passed an act in 2025 that canceled some older incentive schemes. UltraTech's plant there, Sonar Bangla Cement Works, had certificates saying it was eligible for significant benefits under those old schemes.
So they're challenging the cancellation.
They filed a writ petition in the High Court. They believe they have a strong case because the certificates were already issued. It highlights the kind of regulatory risk companies can face.
And there's also the ongoing Competition Commission stuff.
Yes, those appeals against CCI orders from 2016 and 2017 related to penalties. The Supreme Court has granted a stay on the appellate tribunal's order. UltraTech had to deposit 10% of the penalty amount, but they state they're confident in their legal position. These things can drag on for years.
A reminder of the complex environment they operate in. Okay, so pulling it all together, what's the outlook? What did management say about the road ahead? How's demand looking?
Their read was that demand has been steady, to say the least. Government spending on roads is still strong, new projects are being announced, land acquisition is apparently being expedited.
And state governments.
Spending there is picking up too, particularly mentioned Bihar, Andhra, Gujarat, Maharashtra, showing marked improvement. That infrastructure push is still a major driver.
Any specific numbers?
They noted over 2,100 kilometers of highways were built in Q1, up almost 9%. And big projects like the Vadhavan Port, various expressways, those are really kicking off now on a full-year basis. So the expectation is good growth, partly because last year, FY25, was a relatively low base.
What about outside of infra? Housing, rural demand?
Right. Heat waves apparently dampened demand initially, but the monsoon spreading is expected to help rural markets, which they think will grow favorably. Urban housing was a bit slow in the first half of the calendar year, but they're seeing signs of a rebound, more deals, more transactions happening now.
So the overall outlook sounds pretty positive then.
It does. UltraTech themselves are aiming for double-digit volume growth in FY26. They're counting on those new capacities coming online.
And costs.
They expect input costs, like fuel, to either maybe decline a bit or at least stay in the current range. And they noted that if the RBI cuts interest rates, that would obviously help lower their borrowing costs further.
So continued focus on expansion, efficiency, and hoping for some cost tailwinds. Did they mention future growth plans beyond FY27?
They did. Confirmed they are working on the blueprint for the next phase of organic growth. Expect an announcement either before the end of this calendar year or certainly within this financial year.
Always planning ahead.
Seems so. They feel confident they have enough options, both brownfield and greenfield, to keep growing alongside India's development.
Okay, so that wraps up our deep dive into UltraTech's Q1 FY26. What really stands out, I think, is this combination of, well, aggressive but very thought-out growth through acquisitions and how they integrate them, alongside this relentless focus on making operations tighter, more efficient, and greener.
Yeah, if you connect it to the bigger picture, You see a company that's not just, riding the wave of India's growth. They're actively shaping their own future. Smart investments, using tech, pushing sustainability.
Right.
And it really shows how digging into these reports, listening to what management says between the lines, gives you a much richer, more holistic view of where a company is heading and its role in the economy.
So what does this mean for you listening in? Well, getting into the weeds with a company like UltraTech, it doesn't just tell you about cement. It gives you a real feel for the pulse of economic development, how major players strategize and execute in dynamic markets like India.
And maybe it leaves you with a question to chew on. As India keeps building roads, cities, everything, how will this mix that UltraTech is pursuing, this blend of organic growth, big acquisitions, and that deep sustainability commitment, how will that really change the game in the cement industry? And maybe what broader lessons about scaling up efficiently and responsibly can we take from their playbook for other big capital-heavy industries? Something to think about.